Hey everyone, Douglas here, and welcome back to Applied MMT. It's Tuesday, December 19th, 2023, market recap time. And speaking of markets, they continue on an amazing run to close out the year. I think I saw the Dow Jones last week break into new all-time high territory. Today, I saw the Qs breaking out some new highs, and I think the S&P 500 also very, very close to new all-time highs. Just in perfect alignment with I think where we thought we would be, if not anything better than what I think I was expecting at this point. You know, we had that big drain that occurred in September and October, and really was a headwind to markets in the fall months. Of course, that gave way, and right after that drain, we saw flows really kick into high gear, and markets have obviously recouped all of those losses and then some. And like I said, are finishing off the year very, very strong, all in alignment with again where we thought we would be at this point. Real quick, at least on the market front, in terms of the here and now, we do have the tax drain that started on the 15th, and historically the end of the year. Spending slows down, picks back up right out of the gate in 2024, but nothing terribly strong. Then we have a drain at the in the second half of January. Then after that, February, March, April into tax season, we have some pretty strong flows. At least from a flow standpoint, that's what you can look forward to for 2024 as we get things underway. Look, and then just another observation. I do think we are way overbought at this point, and eventually we're going to get a 4, 5, 6% pullback. And I could easily see that happening in just a couple days, spook the markets, reset sentiment, all that good sort of stuff. But still, structurally right now, we have very strong structural flows undergirding at least growth on the market front. I don't see a long-term top happening anytime soon. But as we're going to discuss tonight, if the Fed ends up getting their way, we could be not too far off from said top. Again, I want to be very clear. I don't think this is going to happen in Q1, Q2 of 2024. But if the Fed is able to get through the rate cuts that they are proposing they want to do in 2024, they could easily bring forward the end of the rally a lot sooner than at least I know I was anticipating. So that's what we're going to talk about tonight. Of course, the big news last week on Wednesday, the Fed, after they kept interest rates flat, decided not to make the change. They did come out and say, look, we think we're going to cut interest rates at least 3 times heading into or throughout next year. And we saw that play out in the data. If you look at the CME Fed Watch tool, we saw the March projection, which just last week's video, I was making the argument the exact opposite way, that we were getting surprised back to no cut. Now we're seeing a March cut being priced in. Also, when you look at the Fed dot plot, now this is the Fed dot plot from this most recent FOMC meeting, and compare that to where the dot plot was during the September FOMC meeting, you can see, as I just kind of switch between these, you can see a shift decisively lower now based on the expectations of where the Fed thinks rates are going to be at. So general wisdom is that lower interest rates are stimulative to market growth. Of course, the kind of MMT foundation, the MMT theory, questions that premise. And it questions that premise because when the Federal Reserve increases interest rates, it actually is adding additional interest income to the private sector. This has been the argument that I've been making going all the way back into 2022, that 2023 was going to be a better than expected year because at the end of the day, we were going to see $1 trillion plus of additional interest income hit the private sector in 2023, and that would carry prices higher. Yes, it makes things more expensive, but it also adds additional interest income to effectively cover the price of things getting more expensive. And that's exactly what we've seen play out. So I have no reason to believe at this point that lowering interest rates are going to somehow now really juice things up. And this is where I think the risk is for 2024. It's that the Fed ends up deciding, based on the data that they're seeing, that they want to go ahead and cut interest rates. I think we're on a race to March. I think we're on a race to March 20th to see data come out that continues to be better than expected. If for some reason the data doesn't beat the expectation of where the Fed thinks it should be at, or is even lower than where the Fed thinks it's at, then based on Fed policy, they're going to lower rates to try and get a more stimulative outcome. But that's not going to work, right? 2023 should be now the year that everyone points to in textbooks to say, look, the Fed has it wrong. Obviously, they're not going to change their MO, but if expectations end up being, or if the data ends up being worse than expectations, and I'm thinking growth, I'm thinking inflation, and I'm thinking employment data is worse than expectations, then the Fed might think, oh, maybe we've gone just a little too far in the rate hikes, we need to actually cut rates. The danger with that, this is the key point, the danger with that is if they do end up getting rate cuts in by March, that could actually feed a further deceleration, a further disinflationary impulse that then the Fed a few months later sees in the data as continued contraction, continued deceleration in growth, continued disinflation, which then leads them to want to cut rates once again. In other words, what I'm saying could end up playing out, and I'm going to give you the counter to this in just a second, and why I think the probability is actually the opposite. But what I'm saying could play out is the Fed starts a reinforcing cycle of rate cuts that diminish growth, that become a headwind in front of growth, and cause the very things that they think that they will see that they think they need to cut rates to fend off, such as a contraction in growth, inflation, and a possible increase in employment. So that is one distinct possibility right now. However, we could end up starting to get a surprise to the upside in data. And in fact, today we saw the first inclination of that. Housing starts came out today, and whoa, did they beat expectations? I think it's by like 400,000 or something like that on housing starts. Absolutely tearing higher. And again, this completely undermines the entire idea that higher interest rates are somehow contractionary, that they somehow stand in the way of banks creating loans. They don't. Loans are above all else a function of income. Higher interest rates add additional interest income to the private sector, which increases income for the entire private sector. And that is what we've seen play out. The dip that we saw in 2022 in terms of housing starts and in terms of housing data as a whole was solely a function of the fact that we had, for the first time since the great financial crisis, in real terms, effectively a deficit in terms of year-over-year change. I'm sorry, a surplus, a government surplus. So we were pulling money out of the private sector. 2022, we saw that spending was contracting. That has completely reversed course in 2023, and now we're seeing all markets across the board start to catch up to that reality, and we're seeing that data play out. And I expect housing to continue this upward trend. So if data like this comes out and we see maybe CPI come in a little hotter than expected, at least the print for January, February, March, if we see unemployment continue to contract and employment to look better than expected on the January, February, and March prints before the Fed is able to meet, if that sort of data rolls in, we continue to see at least growth, a la stocks going higher. If we see that sort of outcome play out, then I think there's no way, based on at least stated Fed policy, that they can now go ahead and cut rates because things are looking too hot again. And if anything, if this is how the trend goes into at least through the first quarter of 2024. If that's what the trend is, then the Fed needs to get out there and actually communicate, whoops, we were wrong about what we said back in December. We might actually need to end up raising rates. And if that is how things play out, then we'll see the entire yield curve catch up to that reality, and that will perpetuate everything that we saw in 2023. At this point, especially based on stuff like the data we saw today with housing starts, I think that is the most likely outcome here. The big takeaway is that we are at an inflection point, and one way or another, we are not going to have some steady, soft landing by the end of 2024. we are either going to continue to rip higher through 2024, or we're going to look back at, say, a March rate cut and say that was the beginning of the end of this business cycle based on the dynamics that really only the applied MMT approach can give us. There's one other piece to all of this that I want to point out, and that is an interview that we had over at AppliedMMT with Riddick Goyle. If you haven't listened to this yet, highly recommend it. You can get the podcast on our website, AppliedMMT.com, completely free. You can also get it on the AppliedMMT YouTube channel and wherever you listen to your podcast at. But it was a great discussion, and Riddick is an absolutely original thinker, just a genuinely intelligent guy who clearly sees things differently than everyone else, but in the best sort of way. And the discussion really ended up revolving around his ability to understand that not only from kind of like the MMT capital flow side of things that I explain, where higher interest rates are adding that additional interest rates add the additional interest income to the private sector. Not only is that stimulative, but higher interest rates also are stimulative or not in any way contractionary from an asset allocation standpoint. In other words, banks actually are able to make riskier loans, more loans, when interest rates are higher, because from an asset allocation standpoint, you want your risk-free basket, your risk-free bucket, to generate as much yield, as high as yield, or as much income as possible, because you know you'll get that fallback yield if your otherwise risky loans don't end up having, don't end up paying out the way that you anticipated. So from a kind of asset allocation standpoint, this complements the kind of flow of funds style MMT analysis that I do incredibly well, and just reinforces the idea that higher interest rates assist the banking sector to continue to do what the banking sector needs to do, which is create new loans. And at this point, I think the banking sector is in a great spot because it's just this flood of additional interest income to essentially be well capitalized to kick off the next big bank credit cycle into 2024. Again, it was a great interview. Take a listen. It said you can get it on any device and any platform. So check that out. Like I said, Riddick is a very smart guy, and I think everything that he's doing really complements kind of our approach here at AppliedMMT very, very well. So check that out. All that being said, I think we can put all three of these together. That is that the Fed, as of right now, stating they want to cut interest rates. They can only do this and justify it based on their own stated parameters for the decisions that they make to lead to rate cuts if the data continues to show some sort of kind of disinflationary impulse. As of right now, we're not seeing that. Maybe we do. Maybe we do, right? You never know. The next inflation print could come in a little bit less than expected. The next unemployment print could come in slightly higher than expected. The next CPE print, same thing, could come in a little slower, a little cooler than expected. If that's the case, then maybe the Fed does cut rates, and if they do cut rates, that's only going to transmit down the kind of the entire line of the cycle that contraction is in order, and then it'll be a self-fulfilling prophecy. But at this point, I'm not seeing the data quite yet. The data that we've had at least since last week show that we are in dire straits here from a data standpoint. And if the data comes in hotter than expected, so far that's what we've seen with the housing starts, then I think 2024 will be very much a repeat of 2023, where we're off to the races once again and having a very strong 2024 going forward. All right, I think that's what the main points I wanted to hit. Of course, we got a lot of new information in from the Fed, how they're seeing things. A lot of what I said during the last video, the Fed kind of immediately erased where they did say they might want to cut rates. Again, we'll see. We'll see how it finishes off. My bet is still they don't. My bet is still by the end of 2024 we see rates higher, but look, the Fed is, at the end of the day, they have complete control. They are the monopoly price setter of those rates. And if they deem that is a necessary step to lower rates, they're going to do it. And that will have the consequences that it has. And we'll play that hand if that's what we get dealt. But for now, it's looking like it seems quite unlikely. All right. I think that's what I have for tonight. Just a reminder, if you're an active trader, active investor, head on over to AppliedMMT. That's where you're going to get all the updates that we do each week, as well as access to the dashboard with all the amazing tools that we've built. AppliedMMT.com. That's what I've got for tonight, though. So until next time, good trading, everyone, and we'll talk to you then. Bye-bye.